What if I told you there's a way to review your own tax position before the IRS does, measure how sellable your business really is before a buyer does, and find the weak spots in your protection before a lawsuit or life event exposes them? And what if that review could reveal tens of thousands, sometimes hundreds of thousands, of dollars in missed savings, hidden risk, and trapped business value? Most business owners assume this is already being handled. Their CPA files the returns, their insurance agent renews the policies, their attorney handles the documents, their wealth advisor looks at investments. On paper, everything looks covered. But here's the problem. If we are thinking about expertly piloting our wealth, nobody is looking at the whole aircraft. Nobody is asking, are we leaking money through poor tax planning? Is the owner personally overexposed? Would this business survive a serious disruption? Is the company actually transferable? Would a buyer see strength or would they see risk? That is where business owners get hurt, not because their advisors are bad people, but because their advisors are operating in separate lanes. And the owner is stuck being the messenger between all of them while still trying to run the actual business. That is not a wealth strategy. That is fragmented advice. And fragmented advice gets expensive. It can cost you in taxes, insurance gaps. It can cost you in unnecessary risk, lost enterprise value. And when it is time to sell, it can cost you at the closing table because buyers do not pay premium prices for confusion. They pay for clean books, clean systems, clean risk, clean leadership, clean cash flow, and a business that does not fall apart when the owner steps away. If you are a business owner doing $1 million or more in annual revenue, there is a very real chance you are overpaying taxes, underprotecting your family, and underpreparing your business for the day you eventually exit, not because you are doing anything wrong, but because most business owners are flying without a coordinated flight plan. Let me tell you about Sarah. She owned a $4.2 million manufacturing company. For years, her CPA filed the returns. Her insurance agent renewed the policies. Her attorney reviewed documents when needed. On paper, everything looked handled, but when we reviewed the business through a coordinated tax, risk, wealth, and sellability lens, the story changed fast. There were missed planning opportunities. There were insurance gaps. There was no clear key person protection. Her buy-sell agreement was not properly funded. Her coverage did not match the size of the company she had built. And the business was still far too dependent on her personally. That matters, because owner dependence is not just a lifestyle issue, it is a valuation issue, it is a buyer confidence issue, it is a family protection issue. Sarah told me later, I thought I was protected. Turns out I was one accident away from a serious problem. That is the part most business owners miss. This is not just about taxes. It is not just about insurance. It is not just about investments. And it is not just about selling the business someday. It is about coordination, because wealth does not get protected by accident, and businesses do not become sellable at the last minute. Most business owners do not need another disconnected opinion. They need a flight plan. In part 2, I'll share more about the flight plan we use to help business owners identify tax leaks, measure sellability, coordinate advisors, and prepare for the day their business becomes their largest wealth event. Watch part 2 next.